It's time for our first call segment, and we're taking your calls. And Greg Taylor is with us from Purpose Investments this morning. Our first call comes from Neil in Thornhill, Ontario. Hi there.
Good morning, and thank you for taking my call. I've been around long enough to see downturns. I was very fortunate to take advantage of the 2008 and then in 2020. But now I look at it that there's no political stability now. I'm afraid to put more money into the market. I'm sitting on a lot of cash. If Greg has any suggestions what to do, I'm not satisfied getting 3% in a money market now. And I'm looking for something to do for the long term. I'm a long-term investor. I'd appreciate your comments. I'll hang up and listen. Thank you very much.
Thank you.
Thanks. Well, I was going to say that cash isn't trash, and maybe 3% isn't too bad. So money market is getting a lot of inflows. But if you're looking for more than that, I think you can also look within the bond market to investment-grade bonds. Investment-grade bonds are still yielding 5, 6, the higher percent, and I think should be able to limit you from some downside in the equity markets. And then within equities, I think it's not a bad time to again look at just some more risk-managed strategies. We've had such a big run in the last few years with the S&P up over 20% the last 2 years. That the setup's not great. So having some strategies with some puts or some options overlays that will protect some downside, I think is not a bad outcome. So I think you want to limit some of your market beta and be more, this is more definitely a stock picker's market than just an overall macro market right now.
Can I just ask a follow-on question? Because, and this I think gets a little bit to what Neil was highlighting, is that as interest rates have come down, and arguably we're going to see, at least in Canada, interest rates continue to come down. That idea of, at least in the short term, parking money into GIC. We even spoke to a strategist at CIBC this week who said one of the reasons he's constructive on the TSX is he thinks as that money comes out of GICs, an easy place for it to go is in what are seen as friendlier, durable TSX stocks, dividend-friendly stocks. Do you buy into that idea?
Well, you do. You have to pick the right stocks. And we're definitely getting a rotation back to the value and defensive and dividend stocks. And that's partly why the TSX has had a decent start to the year. But it's awfully tempting when you look at names like a TELUS or a Rogers that are sitting here, or Bell, with nice dividend yields. They have a lot of market sensitivity, so you have to take that into account. But there's some good high-yielding dividend stocks that if you can get comfortable with the backdrop, that's not a bad place to get a higher yield.
Okay, appreciate that call. We have an email from Greg who says he has been a happy holder of Agnico Eagle, but obviously it's had a big move already. Any ideas for an alternative stock? Just a reminder to our audience, Greg, you made the argument earlier that after gold's run up, it might be worthwhile to look at some other opportunities, and then you also made the point that maybe gold juniors might be swallowed up by the larger companies. So anyway, I'm blabbing away. Why don't you talk?
Well, yeah, look, I love Agnico. Agnico is one of the best run companies in Canada, and it has done a lot of great things. And it's also really benefited from the lower Canadian dollar. The bulk of their mines are in Canada. So as the gold price has gone up and the Canadian dollar has gone down, their margins have expanded as their costs have gone down. So, but a lot of that's kind of priced in here. Agnico's had a massive run. It's still a great company, but again, I think it's not a bad idea to take a little bit off the table here. And again, looking at some of the mid-cap or the juniors is not a bad outcome if you want to stay exposed to this space. I would still look at some of the Canadian names like an Artemis in BC or Snowline Gold in the Yukon, which are more mid-tier companies, which would be a nice fit profile for someone like Agnico.
Okay, Artemis, ARTG. What was the other one you mentioned?
Snowline, SGD.
Okay, all right, thanks a lot. We have another email. This is a two-parter. The geek in me loves the first part of this question, which is, when you're looking at valuations, what do you think of price to earnings ratios or price to book value? But there's a second part, which is Ryan is thinking he might want to trim some of his profits on Royal Bank. Now, you mentioned earlier that you think there is some opportunity, broadly speaking, in the banks. Any thoughts on how RBC fits into that?
Well, RBC is one of these stocks that I think you can just have and you don't have to worry about. It's the best in class. It's a global leader. It's doing a lot of good things. The valuation does ebb and flow, and it's also interesting just to look at even the valuation between Royal and TD or some of the other peers, and we've had some blowouts in the spreads on those. But I think RBC is one that you're probably good for the long term. I wouldn't get caught up too much much in the day-to-day moves of this. It's got a nice dividend as well. And I do think the banks are going to do a little better because we're hoping here that we've hit peak negative sentiment on Canada, peak negative sentiment on the Canadian economy. And if things start to turn around, the banks are the sector that usually benefits the most from that.
And then price to earnings versus price to book. What's your favorite metric? Maybe something else?
Well, I'd look at price to cash flow. Do you want to go back to cash flow more than anything else? And book value on banks can be a little subjective.
Price to cash flow is something that works on a whole range of sectors, in your opinion?
Absolutely. Then also just go back to dividend yield is another area that just can work because that's really what you're going to get at the end of the day.
Okay. Great stuff. Greg, thanks so much for joining us. Always good to get your insight. Appreciate it.
Thank you.
Greg Taylor joining us from Purpose, and we appreciate you sending in those emails and those phone calls as well in our first call segment. It's getting very interesting in the tariff tensions with the auto sector now once again in focus, and we're going to take a quick break, but when we come back, we'll get you the latest details on that developing story and get you set up for the market day ahead on the open. That does it for The Street. We'll be right back here on BNN Bloomberg.